Good morning, I'm Chris Beach and welcome to Charting the Markets on IG Live. And it's another week of worrying about whether the US will resolve its debt ceiling crisis. Of course, on Friday we had news that the leaders of the two sides, President Biden and McCarthy in the US, had agreed a debt ceiling deal in principle. But of course, the hard work now begins. They have to get Congress to agree. And already, before all the details have actually been hammered out, there are reports that some members of the Republican Party will vote down the debt ceiling deal. So we are not out of the woods yet. Markets, of course, rallied on the headline that the leadership had agreed a deal between themselves, but we're seeing some of that optimism fade in the beginning of the session so far today. Of course, yesterday was really a write-off for global markets, with all due respect to the Asian session, because of course you had bank holidays in the UK, but also in Europe and in the US, just taking a lot of the volume out of trading. So while we had some modest moves across futures markets in the UK and the US, there wasn't really much volatility. Overall, we've seen further strength in the US dollar this morning, and that's something to watch because not only do we have the debt ceiling deal to look at, but also the chances of a Fed hike in June are edging higher once again, now hitting almost 60% earlier this morning, according to data from the CME, using their Fed Watch tool that predicts a 60% chance of a 25 basis point hike at the meeting next month. That's up from nothing in early April. The view was, of course, that the Fed was now on pause, even though they couldn't say it, and that they would remain so for quite some time. There's still obviously a 40% chance, according to that CME tool, that we will see the Fed leave rates unchanged. You can make a case for why that will still be the most likely outcome, but it's interesting to see how the market's expectation has shifted from pause to actually expecting another 25 basis point hike, mainly because of the strength in US data. Arguably, of course, if you do get a debt ceiling deal before the deadline, that could also perhaps give a bit of confidence in the outlook for the US economy and boost the chances of a rate hike. So there are plenty of moving parts in markets this morning. It is worth noting, of course, that the ex-date for the US, the day which the US government apparently runs out of money, has been pushed back slightly. The US Treasury has gone rummaging around the back of its sofa and found some more money to keep the world's most important government ticking over for just a little bit longer. But of course, if we do have further wrangles over actually getting the debt ceiling deal agreed, that means we could still be in for some volatility. And it's not surprising perhaps just to see some of the optimism, as I said, that we saw on Friday with the headline news of that deal just beginning to fade as trading gets underway across markets in earnest today. But starting with indices, we'll start close to home with the UK FTSE 100 currently trading at 76.07. A lot of this is dollar strength driven, I think now, particularly of course the FTSE 100, you know, the big miners, oil companies. You're seeing commodity prices weaker generally this morning, although we'll come to that in a minute. But certainly that has borne down on the index to an extent, and really continuing to see signs of a pullback here. We were arguably oversold, if you want to put it that way, on Friday. The debt ceiling deal gave us that bounce, but futures on Monday couldn't really hold those gains, and you've seen a little bit of a downside to the FTSE 100 this morning, mostly underperforming the European markets actually. So I think that's really what we're seeing here, is the weakness in commodity prices. Of course, there's concern at the moment about the Chinese economy and how the reopening trade has begun to slow dramatically there, so that of course diminishes demand. Oil, as we'll come to in a second, was hit last week by reports from the Russian representative to OPEC that there wouldn't be another production cut. So you've seen a weakness in oil prices this morning, which of course won't do much for the FTSE 100. So the main thing is to note that we're just reversing the gains. We're still up on where we were on Friday, but losing some of that ground. And you can make a case for why we now see a move back towards rising trendline support from the lows all the way back in September. So that's interesting that the market has got back there. Remember that in March we dipped below that trend line very briefly on the Credit Suisse, etc. drama, but we then rebounded and that held. So if we're looking for maybe a chance for markets to rally, this would be the place, I think, for the buyers to make their stand. You've also got the 200-day moving average just below that. That was breached in March, but of course it's slightly different now because then the trend line was below it, now it's above it. So there are various reasons why maybe we see the price trying to make a defence around 76, 75, 60, 75, 70 in the short term, or slightly lower. And then to have a more bullish view, I think you'd need to see obviously above 76.70. Those are the highest in the futures in yesterday's session. Interestingly, on the way down in the first half of May, 76.80, 76.90 was an area where the buyers attempted to mount a defence there. So there's another level to watch on the upside. That was also, if you go back into April, somewhere where the price encountered a bit of resistance on the way up too. So there's a key level as well to watch for this market as we get above there. You could certainly argue for 7,700 if you want to make it easier, being your line in the sand. Get back above that. Maybe there's a chance for another move back towards trendline resistance from those February highs, which held back progress there, because obviously you've still got this lower high in place here from April, which does muddy the waters quite a bit for this market, which hitherto had obviously been a very strong performer despite the big drop in March. The fact that the rally in April then really couldn't go back onwards towards 8,000 and higher is a bit of a negative sign. Moving to the DAX, solid performer here. Clearly no China worries for the DAX, but as I say, European markets are a touch stronger. No doubt partly, and we'll come to in a minute, because of euro weakness stroke dollar strength. Really, people continue to buy the dollar, which might seem paradoxical given the ongoing debt ceiling crisis, but it is classic risk-off kind of moves. That's weakening the euro, and of course that in its turn tends to, in the short term at least, give European markets a lift. And the DAX, of course, a very solid performer over the year so far. We did see it rally to a new, just about a record high, I think we saw during the course of trading in the middle of the month. It's the highest level in recorded history, back above, crucially, those November and December highs from 2021, recouping all those losses from last year now. So the DAX's remarkable performance continues. Congratulations to anybody who was brave enough to buy the low down in September and hold it all the way through since then. But as unlike the FTSE 100, of course, you've had higher lows and crucially higher highs in place. So uptrend firmly intact there for the time being. We bounced off the 50-day moving average last week. And just seeing a bit of more strength coming through. So as ever, with these kind of, you call it a bull market if you want, with these kind of rising markets, you're looking to buy the strongest performers. At the moment, that would put the DAX, have the edge over the FTSE 100, certainly in trading in European markets, really. The CAC also doing well. Seeing some recovery in luxury stocks there. So continental European markets doing better than their British counterpart this morning, and that means perhaps a move back towards the mid-month highs around 16,300 is back in play, and certainly that bullish view intact unless and until, and I've said this 1,000 times before, we get that move back below 15,700 or so, because that's the line in the sand really on the way up, and it was big support all the way through into the second half of April and so far last week as well. Moving to the US, the Dow, really this year's laggard, of course, among the popular markets for IG clients. European markets doing very well. The Nasdaq obviously really come storming back over the past month. The Dow underperforming even the S&P, has to be said, although still outperforming the Russell 2000. But of US markets, it's one of the worst performers, relatively speaking. Mainly because, of course, the weighting for tech is proportionately smaller here than it is for the S&P. So that's why it's lagged behind a slightly broader peer. You did see, of course, on Friday that huge rally. Of course, be aware whenever you're trading the Dow, those big numbers mean big rallies can happen. Rallying back above the 200-day moving average and trying to do its best to try and put in a low here and try and move back above the 50-day moving average, really. Obviously stalled the last couple of days. US futures yesterday opened, but not much volume. The fact it's back above 33,000 is a good first step, if you like, in a recovery, or recoveries had to begin somewhere. Thursday's reversal was the first move there. The rally above the 200-day on Friday was the next. The fact it's now above these lows from the early part of May, around 33,000, is another good sign of there's a bit more ground being made up. Otherwise, the next big level to watch becomes around 33,600. That's where a rally in the first half of May really faltered. And then beyond that, really, we're looking for it to try and reclaim 34,000 to really get back on an upward footing. Very much a neutral view to this market, which essentially is in the same place it was in November of last year. So really a very choppy ride for the Dow with no real sign of a better move to the upside. Just briefly, maybe if we just go towards the Tech 100 as well. I'll just pull up the chart there for that one, because this, of course, is the big move at the moment. We're at its highest level here now for the Tech 100, the Nasdaq, since April of last year. Huge gains last week. Nvidia, of course, the big driver there with its massive beat on earnings and its rosy commentary on AI. So plenty of good news there for the index. Solid uptrend. Of course, looking at it now, it's definitely probably a bit late to the party, although the breakout is a very positive sign. It's very hard to probably argue for either way because you want to blindly sell into an uptrend at this point because it's probably not the best idea. But joining it now, where would you put your stop? So I think at the moment, chances are the best thing if you're not in it may be to just stand aside and wait for developments. There will be at some point a pullback, but as ever, we can't tell when. It's just worth noting that the price currently up here is a long way away from the 50-day moving average, which is a bit of a sign for caution, if nothing else, almost 8-9% away from the 50-day. So for the time being, yes, it's had a solid run. Very, very impressive gains, and that's what's driven the S&P mainly is the fact it's got a big tech weighting. That's what's driven this market higher. A lot of strength in tech stocks, but no sign really of that slowing down or even reversing, certainly for the time being. But that's why you've got the Nasdaq doing so well and the S&P at a multi-month high, whereas the Dow with a much lower weighting is doing much less well, or more poorly, shall we say. Turning to FX markets, there are signs maybe that euro-dollar's pullback is beginning to abate. Meanwhile, the pound has shown some strength against the US dollar, and the dollar itself, of course, finds itself at its highest level against the yen in a number of months. So starting with euro-dollar, undoubtedly, of course, this is still in an uptrend. Of course, we had a higher low in March, we had a higher high in May, and the pullback, of course, has understandably been brutal, as you might expect. Very much a one-way street here for the sellers, very much enjoying themselves over the past month, really. Taking us back from 111 down towards 107 and briefly dipping below that level in early trading this morning. And of course, it's natural for people to think that that's it. Now it's run its course, and you might start to argue for the price beginning to move to the upside once again. So it's possible that we do see it begin to recover. But of course, you've still got a declining MACD. We haven't yet exceeded the lower highs of the last two sessions, really, let alone go back above, say, 108 and the 100-day moving average. But maybe, even if you look at the hourly chart, maybe there's signs of recovery. But there again, there's your intraday downtrend still solidly there. So a lot of people will be looking at this and thinking, actually, there's still reason why this might continue to turn lower. So until, really, for these kind of rebounds, it's in the context of a longer-term uptrend, but you need to see the price move back above the 50, 100, and indeed ideally above the 200-hour moving average before you start to view this as a higher low being in place. The price action might start to lend that view in a minute, in a short time, maybe in the next few days it might emerge, but at the moment it's still very much a case of just a brief rebound from the lows of the session so far. But nonetheless, the overall uptrend is still firmly in place. Reversal still takes us on down to those March lows around 105.40. We might be seeing signs of a stabilisation in the pound. In fact, we probably are from that look since I wrote up the FX report this morning. Moving back higher from the 100-day moving average. We neared that last week. You've yet to have, of course, the MACD crossover, but it's a lagging indicator. But certainly the fact we're back above last week's high, intraday highs from Thursday and Friday is a good sort of first tick in the box for a recovery and a higher low, because of course this is still more or less an uptrend. It's not quite as elegant as euro dollar, but an uptrend is nonetheless shaping up there, I think. Back above the 50-day moving average would give you perhaps extra reassurance, if you like. Nothing is ever certain, but that would be another interesting development. The fact, of course, that on the way up this 124.10 area was such a big zone of resistance. Of course, it's never a single line. It's worth bearing in mind. It's just area of resistance. Worth noting that we're back at that level now, so we could see maybe some volatility around here. Just to do justice to this and moving above, moving to the intraday view. Yes, again, you've seen it try and break above the 200-hour moving average, but it's a good first step, I think. If you then get it pulling back and it holds above the 50 and the 100-hour moving averages, that again is an interesting sign that maybe we're beginning to see a turn higher here once again. And what has been a very commendable pullback here, maybe it's just running its course. And if it holds above 124.10 and then on above these highs from 124.70, 124.80, that would be another good sign for the pair. Going over to dollar yen, again, excellent run here for the dollar bulls. All this dollar buying really, despite the fact debt ceiling is in the headlines and inescapable, it's just people being risk off really and buying and you're seeing that move across the board, even with, of course, the yen and the fact that Bank of Japan has left policy unchanged has meant the dollar is back in vogue. And as I said at the beginning, those changing expectations around what the Fed will do in June have also driven strength in the greenback. Very impressive rally here, putting back in the uptrend box, but you do wonder really whether we're due some kind of consolidation after what has essentially been an 800-point rally from the May lows. Not often you see dollar yen do that, really. It's not the most exciting currency pair in the world. Nonetheless, it is doing very well. The next target there being the highest in the second half of November, around 142. It could still move in that kind of straight line move if those Fed expectations continue to ramp high. And again, there's your uptrend in the hourly chart. As you can still see that there, very impressive higher lows and higher highs. That's not been broken to the downside yet, so it's hard to argue for any kind of negative bearish view. For that to happen, you need to go back below 139.40 or even lower, really, and then ideally back below 137.90, which was the big resistance level from December into the beginning of May. Otherwise, back on, you might start to argue for, I mean, if you get consolidation here and it then starts to recover, that will probably give the bulls a bit more confidence that this move isn't going to reverse itself. Certainly it's one thing to watch out for. Finally, turning to commodity markets, and there again you are seeing signs of recovery in gold. Worth looking at was oil prices are under pressure once again as the economic data remains a bit grim, to say the least. Gold prices reached the 100-day moving average on Friday, really unaffected by the debt ceiling news, which was interesting, but showing some signs of strength this morning. And that's interesting, the fact, of course, again, you've got an uptrend here, higher lows, higher highs, etc. It could be that we're seeing stabilisation here and a possible higher highs. Definitely one to watch for. Again, if you're looking at the hourly chart, it's perhaps always the point to look at this. At the moment, it really doesn't put much of a dent in that downtrend. You want to see the price moving above the 50 and 100 hour and holding above them, crucially, because that's what it couldn't do last week and the week before. So if it does that, it's perhaps another sign that maybe we're in with a higher low, and that move back towards 2060 could be in the offing. So if you're trading off the daily chart, obviously put your stop below these lows, down towards 1930, 1920, and make sure that it then starts to move on with a target initially of these early May highs, probably the way to look at it. Flipping over to oil prices, just a negativity coming through again this morning. So oil's attempt to move higher has really run its course. Just as with gold, we're looking at the uptrend. Here it's still just about in downtrend territory, although it's been a very tough ride for both sides, really. Just when you think oil is going to definitively break lower, it then rebounded and then straight back down again. It then recovered to an extent, but as I was saying during the course of May, obviously it rebounded from its overstretched lows at the beginning of the month. But the fact it couldn't hold above the 50-day moving average, couldn't even really break above it at all, was an interesting sign. And the fact it's now breaking trendline support from about the 12th of May, 15th of May, from the middle of the month, is another sign that maybe we're off back down. Not immediately, but over the course of time, back down towards $64 a barrel and perhaps lower, unless, of course, OPEC decide to spoil the fun and announce another production cut. But that was the only thing that saved oil prices, I think, during the course of March. We'll see whether that changes over the next few weeks, really. But oil prices, once again, coming under pressure. That stronger dollar not helping matters either. So the sellers look to be firmly in charge once again this morning. So looking at the rest of the day, just US consumer confidence on the calendar itself. Obviously this week is jobs week in the US. ADP numbers Thursday, I think, moved back a day because of Memorial Day in the US, but non-farm payrolls as ever on Friday at 1:30. But watch out for these debt ceiling headlines. As I said at the beginning, yes, they've agreed a headline deal, but now it has to pass Congress. So we could still be in for some volatility. So do bear that in mind when you're trading this week. That's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.